Good day. So our topic for today is cash and cash equivalents. So our learning objective is number one, to define cash and cash equivalent, to determine its characteristic, to determine the measurement and its presentation. So what are the characteristics of cash? So cash and cash equivalent usually consists of currency and demand deposit. And we know currency, these are bills like $1, $2, and so or 1 peso and then the demand deposits, these are our bank deposit. This is also known as the most liquid current asset. That's why it was listed on the top most of the balance sheet as cash and cash equivalent. Insignificant risk of change in value. Why? Because usually what is the value of the money is its real value and no deflation or inflation unless it is forex. So means it should have 3 months maturity or less from the date of acquisition. So meaning if it's these are time deposits or treasury bill, it should have 3 months maturity from the date of acquisition. So once it was determined as 3 months before its acquisition, then it couldn't be anymore classified into other things. But if you purchase this more than 3 months, then it is not cash and readily available for use. Why I separate this is if you would see the second three, these are pertain to our demand deposit. Demand deposit is the most current and liquid asset, insignificant risk of change, even if it's our checks, and then the time deposit. The readily available for use, these are our currency. Next, what are cash items? So we have number one, cash on hand. Cash on hand include undeposited collections, such as coins and currency, customer checks, manager's check, traveler's check, cashier checks, and money orders. So these are cash on hand, meaning for example, there are teller who would be receive the money, like for example, our Bayad Center, those who paid in cash that are not yet deposited in the bank, whether it is our checks or coins and currency, then these are cash on hand. However, post-dated checks will be discussed later. We also have cash in bank, so this include demand deposit, and we know what's demand deposit is. Demand deposit is our saving account, and checking account is our current account. Okay? Checking account and saving accounts which are unrestricted for withdrawal, because there are certain money that are restricted for withdrawal, and this is what we call our compensating balance. So cash fund, working fund segregated for current purpose such as petty cash fund, change fund, payroll fund, dividend fund, tax fund, and interest fund. So these are money we segregate or into our petty cash or in our certain fund so that we could pay outright expenses that are needed to be paid. Next, according to IAS number 7 or International Accounting Standard number 7, required shorter maturity, which is defined. This is the reason why we have 3 months maturity or less from the date of acquisition, because they said short maturity pertain only to 3 months from the date of acquisition. Okay? So example of these are 3 months BSP Treasury Bill, 3 months time deposit, 3 months money market instrument, or commercial paper. So you had to check whether you acquire this particular demand deposit or this particular account 3 months before its maturity. So be careful with the dates. Next, what is its measurement? So usually, cash and cash equivalent are measured at face value, which is also our fair market value, meaning anybody would be able to accept this currency at that amount. So exemption, take note, our exemptions are foreign currency, because foreign currency are subject to exchange rate if restricted as to withdrawal. These are now reported as other asset. If unrestricted for withdrawal, then it should be translated on its functional currency. So here in the Philippines, our functional currency usually is peso at the reporting date, so that you wouldn't have a different value for each of the forex. Next, we also have cash in a closed bank or bank having financial difficulties or bankruptcy. Because take note, this particular bank, you cannot automatically withdraw your money because they are closed or had filed bankruptcy. Like now, in COVID case times, I mean, a lot of company would close. So for that instances, we cannot report it as readily available because there are certain law ruling that has first to verify all the depositors. So you cannot use the money outright. Hence, this should now be classified as receivable, written down to its recoverable amount. Take note, if you deposited 1 million, the recoverable amount is only 500,000 under our PDIC. Okay? So we also have presentation, cash in closed bank, or banks that are having financial difficulties or in bankruptcy should now be classified as receivable and written down to its recoverable amount. So sometimes you cannot automatically get the entire amount because these are closed bank. So you have to write this down on a particular value. Like for example, here in the Philippines, 1 million deposit in a closed bank could only be recoverable in only 500,000. Next, we also have customer post-dated check or those that are marked not sufficient fund or drawn against insufficient fund or drawn against unclear deposit check. So if this particular check should now be classified back to our receivable and not cash. Because post-dated check, you cannot go outright or you cannot use it immediately. You also have postage stamp and expense advances. So postage stamp are not classified as cash because you cannot use this as a payment. Hence, these are also classified as our prepaid expenses and so as the expense advances. Next, we also have bank overdraft. Bank overdraft should be reclassified as liability under IFRS or International Financial Reporting Standard unless the same bank with different account or has right to offset is allowed. So, but here in the Philippines, it's not allowed. But you could also offset when you have deposit from this particular bank. This particular bank, different kind of deposit, but this bank allows you to do the offsetting. So, undelivered or unreleased check, company issued post-dated check. Take note, if you were the one who issued post-dated check, the other entity would not be able to encash that and hence it should be reported back to cash. Now, we also have compensating balance because there are certain bank loans that need to have a collateral of another deposit and these are what we call now as our compensating balance or the minimum amount that the entity agree in the bank as collateral for loans. But take note, compensating balance has two kinds. So, normally, if it's not restricted, it should now be classified as cash and cash equivalent. But, we have to disclose it in our notes to financial statement that these are compensating balance. However, the legally restricted compensating balance, since we cannot withdraw it, then it should be classified as current or non-current depending on the loan that it represents as collateral. And those that are cash set aside for long-term specific purposes, meaning we cannot use that, hence we should also classify this as non-current asset. Example of these are sinking fund, plan, pension fund, and others that are alike. Okay. Next, we also have still check or check long outstanding. If not in cash within 6 months from the time of the issuance or a certain stop payment order will be reverted back to cash. Take note if that one we had to revert that to cash if it's long outstanding checks or still checks. Okay. So we also have cash management. Why do we need to have cash management? So an effective cash management is required to control or protect the most liquid asset from theft or fraud. Because take note, cash is those that are easily concealed or easily be involved with fraud. So therefore, the following controls should be noted. So these are for our audit. Number one, there should be segregation of duties in handling cash and recording transaction. So take note, the cashier should be separate from accounting. A periodic bank reconciliation so we could avoid window dressing or lapping. And then we also use the voucher system because voucher system and check system would be easier for internal. So there would be audit trail. We also have internal audits at irregular interval. And then we have petty cash that can be accounted either empress or fluctuating system. Okay, so what are this kind? So the essential, most company would use the empress system. Why? The essential feature of Embrace system, it has fixed amount of cash allocated to petty cash fund, which stated in a separate account or in a general ledger. So usually they would have a separate book for the petty cash fund. These are now, we check on the accountability of the petty cash custodian. We also have check for all cash distribution from petty cash fund and the documented receipts, so that we could check the accountability or the amount that has been go in and out of this particular cash custodian. Petty cash disbursement receipt are used as the basis for periodic replenishment of petty cash fund, and variances between expected and actual balance are regularly reviewed and investigated. So take note, we usually use the investigations to determine if there are some pilferage or some dues for personal use of the petty cash fund other than the business. Okay, we also have fluctuating system. However, fluctuating system, we also record this in our book as receipts that are directly fund with credit. So meaning we record all the transactions. Unlike Embrace system, it has a separate recording and we only record it in our actual books when we replenish or increase the cash advances, and at the end of the year, so that we will be able to record all the expenses. So example, let's do some example. So we have KKR company for the year ended December 31, 2020. The accountant gathered the following data. Current account with the LBP, with Land Bank, 2 million, NDBP negative 100,000. Payroll account for branches, 500,000. Foreign bank account restricted, 1 million in peso. Postage stamp, 1,000. Traveler's check, 50,000. Money order, 30,000. NSF check, 15,000. Petty cash fund, 4,000 in currency, and receipt, 6,000. Treasury bill due on 3/21/2020, 200,000 purchase in December 15, 2020, and 500 purchase in 2019. So let's see which one is included. So we have now our current account in LBP, 2 million. Take note, the negative balance is not included because these are two different banks, so offsetting is not allowed. We also have payroll account for branches, 500. Traveler's check. Take note, NSF check are not included because we reverted that back to receivable. We also have money order. Petty cash fund only 4,000 because take note, 6,000 are expenses. Treasury bills, those are only for 2020 because the other one is purchased 1 year, more than a year before its maturity, and therefore our answer is 2,784,000. Okay, if you have any questions, just comment below. And if you like this video, please help me reach out more people by hitting the subscribe and the like button below. God bless you and keep safe. If you have questions, please comment. Bye!